Today I'd like to take you on a guided tour of David Barse's resume, back to when he was CEO of Third Avenue Management. This was a firm that ran a mutual fund called the Focus Credit Fund. And let's just spoil this by saying it didn't go very well. We dig in here. They were sued in a class action lawsuit for violations of federal securities laws. That's not a good start. And this might be also somewhat familiar. They were sued by a retirement plan, and effectively they feel that they were misrepresented what the investment that they were investing in was. They thought that this was an open-ended mutual fund that they'd be able to redeem whenever. But it turned out that mutual fund invested in illiquid assets. The fund blew up from $1 billion to $3.5 billion. So meteoric growth. The case centers on one of the largest implosions of a mutual fund in the history of financial markets. So David Barse is distinguished by creating this amazing accomplishment that we can all look to. If the Guinness Book of World Records had a category for largest implosions of mutual fund, you would see his picture there. But in the meanwhile, I will treat you to this picture of Mr. Barse, myself, Daniel Frischberg, and Emmanuel Herman, which Mr. Barse requested at the mediation session. So interesting choice to fangirl out about Daniel Frischberg, but that's the level that we're dealing with here. Seems like a nice enough fellow, but what's he doing leading this process? Mashinsky's friend leading this process.
And today I have a special guest, somebody I've known for a very long time, David Barse.
It's my pleasure to be here, especially for you, Alex.
Mashinsky's friend who denied on the David Lynn show that Celsius's failure was caused by Celsius's actions.
For those people who may not have very closely followed the Celsius case, how did all this happen?
You look at, you had, the so-called crypto winter last year, and most of it began with the drop in the price of some of the underlying digital assets, Bitcoin being sort of the primary reference point. Many of the participants in the space were all interconnected in some way or another, whether through borrowing from one or lending to one of the other. And so as the price of the digital assets deteriorated and some of those digital assets were used as posted collateral, you saw this sort of massive unwind, if you will. And it's not just Celsius, but obviously many, many other participants in the digital asset space have experienced their own demise, and that has still not completely flushed itself out, as we're seeing in the news this week.
To not take responsibility for what Celsius did when you're representing the most senior levels of management as a member of the board, that to me is unforgivable. You need to take ownership of what Celsius did. Granted that you weren't physically present for that, but you inherited your board position and you need to be honest about what Celsius did. And unfortunately, he was not. And how can you trust somebody who lacks fundamental honesty? And we'll see from this lawsuit that they weren't honest with their numbers. Another pattern that is repeating with Celsius. Celsius lies with their numbers by removing depreciation, by prepaying expenses. You can't get a good sense of how mining is performing. And that's intentional. They don't want creditors to know how fucking horrible they all are. And that is just, why would you want to do business with people that are liars? And when it comes to the lawyers, they lie by omission. Apparently, that's perfectly fine within legal standards. But when it comes to, say, the depositions, they did not furnish relevant information that would have made those depositions far more illuminating. So they're protecting their criminal clients. The very notion that, say, a Chris Koenig has voiced, that Celsius only has obligations to fulfill paying out the petition date prices, that there's no causes of action beyond that, is so outrageous. It's how can you possibly argue that? These geniuses have never even bothered explaining where the yield came from. It's obviously Ponzi yield. There's no explanation. Like, there's no possible way that it's anything other than just made up fantasy yield. And the fact that Alex Mashinsky's defense in his civil trial to say there was no link between earnings and the rewards paid to customers, that's effectively just admitting that this is all a Ponzi scheme. You didn't have enough funds raised from equity to pay out $1.36 billion in rewards. And even if the rewards were paid exclusively from equity, then you've defrauded your equity investors. Nobody is investing funds in a company to just pay out rewards to somebody else. It's complete nonsense. The only reason you raise equity is to build a business. We'll go back to the Focus Fund here and talk about how they lost money. So unbeknownst to investors, the Focused Credit Fund invested heavily in highly illiquid, distressed, and defaulted securities. Not smart. And that's not appropriate for an open-end mutual fund. Specifically under SEC rules, no more than 15% of a fund's portfolio is permitted to be invested in illiquid securities. But they're like, you know what? We're going to just go for that high yield. We want double-digit yield. We're going to go buy that real junky nonsense. So they loaded it on up. And the Focused Credit Fund misrepresented the amount of illiquid securities it held. As such, the fund was a house of cards waiting to be knocked down as soon as the fund received large requests from investors. This is so similar to Celsius. When you have an insolvent entity that's unable to service redemptions from customers, it's just a ticking time bomb. Ponzi's only get exposed once the market takes a turn for the worse and people want their money back. That's exposing the fraud. It's always going to happen eventually. If you're losing money perpetually over time, you're eventually going to run out unless you keep raising money from other investors. And obviously, there's a limit to how much money you can raise. So, Ponzi schemes have a short shelf life. Bernard Madoff had the longest running Ponzi scheme that I'm aware of. He made it over 2 decades. Alex Mashinsky couldn't even make it 5 years. So, amateur. Between the start of the class period and the summer of 2014, investors poured money into the fund, causing assets to increase from approximately $1 billion to $3.5 billion. The large inflow of new investments during this period masked the risks associated with the fund's illiquid investments. Again, that's somewhat similar to what happened with Celsius. They were bragging about their assets under management, and maybe that lulled people into a false sense of security. They have so many assets, surely they can meet my redemptions. Unfortunately, beginning in the summer of 2014, as new investments slowed and redemptions increased, the fund was forced to use its cash and liquidate securities to honor redemptions. This resulted in the fund becoming even more concentrated in illiquid securities. And then during 2015, as redemptions significantly exceeded new purchases, so did the pressure on the fund to liquidate securities to meet redemptions. And since the fund was not sufficiently liquid to meet redemptions, it was forced to sell illiquid securities well below their stated values. This caused the fund's share price to decline, which resulted in even more redemptions, more selling of illiquid securities, and more declines in the fund's share price. Just this spiral. By early December of 2015, the fund's shares were down by 27% for the year. Then, on December 10th of 2015, the fund shocked the investment community by unilaterally suspending redemptions of the fund and publicly acknowledging that due to the level of the fund's illiquid securities, shareholder redemptions were negatively impacting the fund's net asset value. In other words, the house of cards was collapsing, and the fund halted suspensions in order to save the remaining few cards standing on the bottom row. By that time, the fund's shares closed at more than 45% below their class period highs. Now, do you not get Celsius vibes from this?
Hi, everybody. While we navigate some very difficult challenges, we will be pausing AMAs for now so Celsius can focus.
We apologize for the profanity, which he also said on our air.
Good to know David Barse has experience with unilaterally suspending redemptions. David M. Barse was at all relevant times the chief executive officer, president, and a trustee of Third Avenue until he was fired in December of 2015. He was basically frog-marched out of his company. Did not end well for him. But he landed on his feet and he founded a new fund that specialized in picking loser companies. It's kind of a weird strategy. Oh man, so I've come across this article about the origins of XOUT, and it turns out that he was accused of basically ripping off his business partner's idea. So another acrimonious split. So Alec Ellison left Jefferies to start a new investment company, and he joined forces with David Barse, who had just got fired from Third Avenue Management. So they teamed up, and then they had disagreements. Weird. Barse is having disagreements. So Barse resigned and then started a new company called XOUT Capital. That separation and the resulting acclaim lauded upon Barse is at the center of a disagreement between the two that now, for the first time, is spilling out into the open. So Ellison is claiming they had multiple differences in how to move the OutVest fund forward. And the terms of their business partnership recognized Ellison was the creator of the firm's investing strategy, and that he coined the ticker XOUT for an exchange-traded fund that OutVest had planned. So basically, Ellison is claiming that he developed the idea of XOUT, which Barse just left and took. So, not really ethical. No wonder Mashinsky picked this guy, huh? Not bad. Not bad at all. The only thing more important than what you put in your portfolio is what you X out. Beautiful. So yeah, Barse picks losers and he just takes them out. And then what does he put in? I guess everything left? A brilliant strategy. That's so much better. You invented a blacklist instead of a whitelist. And you're a brilliant man. This is why you are having praise lauded upon you, or acclaim lauded upon you. So we got to save this article. That's pretty good. This was a red flag for me, says Ellison, who is accusing Barse of appropriating the XOUT ticker. Ellison says he also feels XOUT Capital copied the overall approach of excluding companies from an index based on vulnerability to technological disruption. He says he can't comment on the degree of copying as he has not reviewed the specific algorithms that XOUT Capital is using. So David Barse is the Mark Zuckerberg of picking loser investments to eliminate. All right, well, enough of that article. When the fund began offering shares to investors, it represented that it sought to achieve an investment objective of long-term capital return, mainly by investing in bonds and other types of credit instruments, and planned to invest a substantial amount of its assets in credit instruments rated below investment grade. The fund was categorized as a high-yield fund by mutual fund rating services Morningstar and Lipper. So the fund was required to maintain adequate liquidity to meet customer redemption requests, which is also something that a kind of crypto bank might be expected to do. An open-ended mutual fund, such as the Focus Credit Fund, provides investors with a safe, easy, low-cost way to pool their money with other investors to benefit from professional investment management, diversification, and liquidity. Trust the professionals. People buy shares in open-end funds for different reasons, such as investing for retirement and their children's college education. Institutions also invest in open-end funds as part of their investment strategy. Shares of open-end mutual funds are bought and sold at the NAV of the fund, which is based on the value of the fund's underlying assets and is calculated at the end of each trading day. So net asset value makes sense that you would use the fund's assets to calculate that. So open-end funds typically redeem investors' shares within one business day. Unlike common stocks and closed-end funds, the prices of shares of open-end funds are not supposed to be impacted by ordinary market forces of supply and demand of the fund's shares, because purchases and sales of shares are made directly with a fund instead of with other investors. So they're supposed to be liquid. Yeah, liquidity management is pretty important. And if you have a bunch of bozos who don't know how to do that, then you wreck your investors. If a fund does not have an appropriate level of liquidity, shareholder redemptions could force the fund to sell assets at below reported prices, which would negatively impact the fund's NAV and reduce the value of the shares held by non-selling shareholders. So you have people that are screwed left behind. Not good. Let's fast forward here. The focused credit fund was not sufficiently liquid. Throughout the class period, the registration statement stated that the fund's portfolio was sufficiently liquid to meet customer redemptions on a daily basis and in no event longer than within 7 days. In turn, the registration statement stated that less than 15% of the fund's securities were illiquid or not readily marketable. So they're telling everybody, look, we're under that 15% threshold. The SEC says we can't have more than 50% of liquid assets. We don't. They're basically just lying. Nothing like having a practice liar in charge of the Celsius reorg. Wonderful job, everybody. Wonderful job. So the registration statements also claim that liquidity of the portfolio was closely monitored. So they're watching it like a hawk. Liquidity under control. We got this. Just don't withdraw your funds, but yeah, we got this. Contrary to these representations, however, the fund was not sufficiently liquid. First, more than 15% of the fund's securities were liquid throughout the class period. Second, the fund did not maintain a level of portfolio liquidity that was appropriate under the circumstances. And third, since the fund did not maintain sufficient liquidity, investors were exposed to an undisclosed substantial risk that if share purchases decrease or if the fund experiences more outflows than inflows, the fund would be forced to sell illiquid assets for less than their reported prices, causing a decline in the fund's net asset value. So finally, investors were exposed to an undisclosed risk that they would be unable to redeem their shares within the 1 day represented by the fund, or even the 7 days required by law due to liquidity issues. So a huge liquidity problem that they didn't address. They lied about their liquidity problems. On December 10th of 2015, the undisclosed redemption risk materialized when the fund suspended all redemptions by shareholders. Liquidity issues that caused the suspension were not a sudden event. Rather, liquidity problems plagued the fund since at least the beginning of the class period. Pretty bad. So then BlackRock did an analysis and they concluded that the focused credit fund was not sufficiently liquid during the class period. So they looked back in time and found that they were full of baloney. So the focused credit fund just YOLO'd in on high coupon rates. So they chased high yield. They're like, ooh, double-digit returns. Let's put all our money in there. Maybe they didn't realize that those returns that are listed nominally higher may come at a risk to your principal. More than half of the bonds they held paid more than 10%. It's not a good sign. You're really chasing yield. And when you chase yield, you get wrecked. The fund reportedly scooped up large amounts of distressed debt and unrated securities, becoming the largest holder of certain loans and securities that traded infrequently, according to a person familiar with the matter. These guys are just buying the crappiest crap to ever be shat. This is not good. This is bad. I mean, is this worse than spending $600 million of investor money on mining facilities that would lose many millions more on top of that? I don't know. Look at this here. So they reported that another investment firm took over the fund's private equity position in a Longview Power LLC based in West Virginia, and they got in at a 40% discount. So these guys, they got 60% back on their investment. Whew, that's not so good. Not so good. So these guys were willing to take 60 cents on the dollar in order to raise funds to beat redemption requests. As demonstrated by the analysis above, unbeknownst to shareholders, limited markets existed for the sale of a substantial portion of the fund's assets. Indeed, an article in the New York Times deal book entitled A New Focus on Liquidity After a Fund's Collapse described the fund's portfolio as skewed towards high-risk, high return turnaround positions in which the bonds traded so infrequently that determining a price for them was little more than guesswork. So they couldn't determine a market price because the market was so illiquid. It's almost like markets aren't always reliable in terms of determining an asset's value. Weird. I wonder if that could apply to anything else. Nothing comes to mind. Sell token. By the standards of most mutual funds, only level 1 assets are deemed to be liquid. That is, capable of being sold at a price near their valuation in a reasonable period of time. The Third Avenue Focused Credit Fund had over half its assets in level 2 and almost 20% in level 3, which sometimes is called mark to myth. These figures stand out starkly against the SEC's general rule that open-end funds are to limit their holdings of illiquid securities to 15% of assets or less. So you have complete incompetence in terms of running this fund. They were not even close to being in compliance. So in January 2014, the SEC was issuing a risk management guidance update for fixed income markets investing, encouraging the investment advisors for bond mutual funds such as the Focused Credit Fund to evaluate and stress test their liquidity. And they didn't do that. So contrary to SEC guidance, the fund continued to grow its illiquid portfolio and failed to diversify its portfolio away from highly liquid assets. So some good guidance that they just ignored. They did their own thing. According to a Third Avenue Management Due Diligence Questionnaire from 2013, the fund admitted it should not accumulate more than $3 billion in assets. So what did they do? They accumulated more than $3 billion in assets. They got to $3.5 billion. Like, these guys were really running wild. Investor in the fund approached the fund's portfolio manager, Thomas LaPointe, out of concern that the fund had grown too large. LaPointe reportedly responded he was dealing with the growth even as he allowed the fund to take more investors' money. The fund stated, "We're under control. We have plenty of cash." Plenty of liquidity. Do not worry. We have this under control. The Wall Street Journal also reported that our good friend David Barse himself, citing a former employee who worked with him, internally voiced some concern about the risk of holding hard-to-sell assets while allowing investors to sell out in a day. He was worried about the mismatch, but unfortunately for the fund shareholders, these internal concerns were not made public until it was too late. So I wonder if this approaching truck will run me over. Maybe I should move. This reminds me a bit of Celsius holding FTT to secure loans from FTX. They understood in their risk meetings that this was a wrong way of risk. So they're aware of the risk, and yet they still run into the problem despite their being aware of it. Classic mismanagement. So the poor liquidity of the fund and its inability to meet redemptions led to its downfall. In the suspension application, Third Avenue stated that the fund has experienced a total of $1.1 billion in estimated net outflows from January 1st of 2015 to December 9th of 2015. Furthermore, Third Avenue admitted that there was a direct connection between redemptions and a reduction in the fund's net asset value. Third Avenue stated in November of 2015, the fund experienced a total of $317 million in estimated net redemptions. The fund's institutional class net asset value per share fell from $7.81 to $7.08. Similarly, Third Avenue wrote on December 9th of 2015, after considering the environment the fund was in and the likelihood that incremental sales of portfolio securities to satisfy additional redemptions would have to be made at prices that would unfairly disadvantage all remaining shareholders, the board determined that the fairest action on behalf of all shareholders would be to adopt a plan of liquidation. This is actually pretty interesting here. Furthermore, contrary to Third Avenue's characterization of the level of redemptions as extraordinary, other high-yield funds experienced similar redemptions but did not suffer the same disastrous fate as the fund. So this is them claiming that it's some sort of environmental issue. It's not our fault, it's just the general situation we're in. That's the exact same excuse that David Barse used on the David Lynn show.
It's not just Celsius. The so-called crypto winter last year. Crypto winter.
The company notified shareholders that due to liquidity issues, Third Avenue froze all redemptions and adopted a plan of liquidation for the fund. Defendant Barse attempted to justify the plan by claiming that we believe that with time, FCF would have been able to realize investment returns in the normal course. Investor requests for redemption, however, in addition to the general reduction of liquidity in the fixed income markets, have made it impracticable for FCF going forward to create sufficient cash to pay anticipated redemptions without resorting to sales at prices that would unfairly disadvantage the remaining shareholders. While we believe that these investments are likely to generate positive returns for shareholders over time, if FCF were forced to sell those investments immediately, it would only realize a portion of those investments' fair value given current market conditions. What was the statement that Celsius put out when it froze withdrawals? Wasn't it something like, we intend to honor our commitment to withdrawals? Due to extreme market conditions, today we are announcing that Celsius is pausing all withdrawals, swap, and transfers between accounts. We are taking this action today to put Celsius in a better position to honor over time its withdrawal obligations. Acting in the interest of our community is our top priority. So this is pretty similar language in terms of honoring over time. According to media reports on December 11th of 2015, days after shareholders were barred from getting their money out of the fund, defendant David Barse presented a last-ditch effort to sell the fund's assets to a private equity firm. That move was promptly rejected by the board, resulting in Barse's termination. So he was fired for trying this Hail Mary move, was trying to just sell it off to a private equity firm to effectively escape culpability, looking for the easy way out. But then he was outed. So David Barse didn't consult the SEC as he was supposed to. After he was fired is when Third Avenue actually got SEC approval. So not exactly a regulatorily responsible party to be overseeing the Celsius bankruptcy proceedings. Somebody who spurned the SEC when he was required to consult with them. You know, he's only earning a little over $1 million a year. Not that big a deal. It's not like we have people that are on minimum wage or disability that have their life savings on Celsius. And it's not going to look bad because we're just not going to pay attention to it. We're just going to move on. The defendants admitted in their suspension application that the fund's liquidity issues caught up to them. They were forced to realize that there was an imbalance between selling interest and buying interest of their overpriced and illiquid assets. Let's read a statement from Jim Cramer, who commented on this. Now, there are two parts to this Third Avenue story. First, there's the unprecedented decision from the firm's former CEO, David Barse, who no longer works for Third Avenue as of this weekend, to cease redemptions of a mutual fund without even consulting the SEC. This focused credit fund wasn't a hedge fund that could have special rules like Stone Lion Capital Partners, another fund that cut off redemptions Friday evening. Focused credit is a mutual fund. And implicit in the nature of mutual fund is the notion that there's a posted price of what the fund's worth, and if you want to redeem your shares and get that price today. That's just mutual fund management gone rogue. There are rules. Rules have to be followed, including running money in a responsible enough way that you have liquidity on hand to meet redemptions when your fund is doing badly. You stop buying, you start selling, and you raise cash aggressively at any price, because when your fund is down 27%, as this was, according to published reports, going into this catastrophic decision, you have to accept that people will want their money back. The unilateral decision to cease redemptions on the spot, to me, is tantamount to a repudiation of the laws set up to protect investors in these kinds of vehicles. I do not know how the authorities can overlook this decision as focused credit was some sort of hedge fund with a lockup. Which brings me to the second damning part of the equation here. Looking at this list, I can't believe that this fund had the guts to say it was only down 27%. I think that these pieces of paper were so ghastly that in order to sell them, they'd be worth half of what they might be carried out. And that's why I think it had to close. Only a fool would bid on most of these assets. I don't even know at year end if they could get prices for them to close their books. So he just brutalized them with that statement. Just talking about, really, the fact that they violated the laws to this degree, there could have been criminal consequences for Mr. Barse. This was such an egregious mismanagement. But incompetence over fraud, perhaps. So this is extracted from the registration statements here from 2013 to 2015, and they're listing their illiquid percentages to be under 15%. And they're saying in the plaintiff's remarks here that this was inaccurate statement of material fact. So they are saying that they're under the 15% threshold, when in fact, the analysis that we looked at earlier said that they were at like 70% at one point illiquid beyond level 1. So, wow, they just straight up lied. Lying to your face with false numbers. Why would you want somebody who presided over mistruths and lies in a case such as this? This case would eventually be settled for $14.25 million, which sounds like a lot, but in the context of these numbers, wasn't particularly that much. They did get their settlement without having to go to a jury trial, so that likely saved a substantial sum of money. So better for all parties to come to a settlement. It could also be that there just wasn't enough money to pay much more than the $14 million. So I hope it's been interesting to take a little tour back through David Barse's career. Again, he never submitted his sworn statement to the court as was promised by the debtor's counsel, Kirkland, which is disappointing because it would be nice to have heard from Mr. Barse. When you read history like this of what can only be described as profound mismanagement, it does lead you to question whether this is the right person for the job. Yes, you want somebody with deep experience, but that experience should be in fixing things related to restructuring, not causing them. So, wouldn't have been my choice being appointed by Alex Mashinsky, never issuing a statement to condemn Alex Mashinsky's actions, never admitting that Celsius had done anything wrong, rather blaming market forces and saying that all our peers are facing the same types of problems. That is just pure gaslighting. And seriously, somebody who has that attitude has either no idea about the facts of the case or is simply dishonest. And in either case, they belong nowhere near this restructuring effort. These board members are making approximately $1 million a year. And are these even their full-time jobs? Then they're presiding over funds collected from many people who are either retired, disabled, or on relatively low wages, paying investment bankers and lawyers $1,000 an hour and up. It's a horrible look. This whole process is just very dispiriting because it fills the pockets of people that are in the high earnings bracket while victimizing people who trusted a company that was fundamentally dishonest. And that same company's leader has hired board members who are effectively unaccountable to the broader public. The insiders claim that they're involved in the process in a positive light, but they're not communicating that to the outside world. And that's what's important. There's been no effort to build trust with the general creditor class. The board members have just been silent. They are in their gilded towers. They don't need to communicate to lowly creditors. So this was an attempt to at least turn a light on the past of one of our board members. I hope you found it helpful. I'll see you later.